COSO Enterprise Risk Management ERM Framework. This topic is now being tested extensively by your examiner, so you need to read it to that extent. COSO ERM was introduced in 2004 and later on it was updated in 2017. Which entities behind this framework? The entity behind the framework is COSO, the Committee of Sponsoring Organizations of Treadway Commission. It's an entity composed by 5 members: Institute of Internal Auditors, US, American Institute of Certified Public Accountants, US-based entity, Institute of Management Accountants, AAA, that is American Accounting Association or maybe something similar, and FEI, the Financial Executives International. Of these, this is the most powerful accounting entity in the US, followed by IMA and then Institute of Internal Auditors. So these 5 entities form this organization and they gave you the COSO ERM. Please remember, these bodies collectively formed COSO. COSO is not a governmental entity. This body is only constituted to provide you the thought leadership. This COSO ERM does not have the force of law. The COSO Internal Control Framework, which you studied in CMA Part 1, Section E, was also so without any force of law. It's just for your guidance. You may use it if you wish to, or you may not. It's totally up to you. So this model was specifically for risk management for the company as a whole. The question is it the only model? It is quite prevalent, just like COSO Internal Control Framework is a very popular model for internal control frameworks. COSO ERM is also very popular. Regarding its application on the organization across the world, I'm not very sure, don't have any statistics on that, but there are other frameworks as well. ISO 31000 is somewhat similar framework. COBIT, this is specifically related to risk management related to IT. Then FAIR, FAIR, Factor Analysis of Information Risk. This is probably the only model that involves computations. It's a quantitative risk management system in which you have lots of statistics. Interestingly, it's not a part of your syllabus. Clearly, it is studied in FRM. NIST, Framework for Improving Critical Infrastructure, Cybersecurity, Basel Accords, then the Turnbull Guidance. So there are other. So this, of course, is one of the most popular frameworks. So what is the difference between COSO ERM and what we have been studying so far? We need to know. We need to know the difference so that we can understand the idea better. What we did in traditional risk management, the topic we discussed previously, the risk focuses on individual departments. Typically, the risk management focuses on individual risks or siloed risk areas. Siloed means you have distributed your organization into different functions or departments, finance, treasury, maybe, or accounting, or risk, inventory, sales, marketing, and we have separate risk management activities for each department. This is called siloed approach, or the compartmentalized approach, in which the risk management is done in closed boxes without any coordination, without any interaction between these departments or segments. Clearly not a very efficient approach. It is not an integrated approach. So about COSO ERM, it's a holistic approach which sees how these compartments are connected, how one department affects the other. And it considers risks across the entire organization rather than on just some closed compartments. It takes a holistic approach. What is a holistic approach? It's just like you take an aerial view of the ground. When you take an aerial view, you get a much larger picture under your view. So you get to develop a very good sense of connectivity. How things are connected, that is only possible when you see things from a very high level. So this is the idea in COSO ERM, that we take a holistic approach. We take a bird eye view of the whole organization and we see how the things are connected, how departments are connected, and how risk affects different departments. Rather, considering risks across the entire organization. So this is the first difference. Second, I just told you this idea. Risk management traditionally is compartmentalized within different departments or divisions. But in COSO, risk management is integrated for the organization as a whole. Our strategy is based on this combined risk management, our operations. So in other words, you can say it integrates risk management into the organization strategy as well as its operations. So there is an element of connectivity in it. Then it emphasizes the traditional system we discussed earlier, emphasizes on or emphasis on the minimizing of loss. We focus on how to minimize the losses. So it's quite a, you may say that a reactive approach. Our focus is on just to keep our losses to the minimum. In this case, we avoid risk. The idea is just to keep as much risk or take as much risk as you can. But COSO goes one step ahead. Okay, go ahead, take risk. If you take risk, you make money. So here we just don't shy away from risk. We don't run away from risk. Risk is bad. COSO takes risk positively. Sometimes we have to take risk because that might result in some benefits as well. So the key point here is that in COSO, we emphasize on maximizing opportunities, because if we take on risks, we make more profit, we make more money. So while being safe, being on the safe side, protecting ourselves as well, but to maximize any opportunity that comes our way. We don't just run away from opportunities just because they're risky. Sometimes we welcome risk because risk taking sometimes can lead to a very high level of returns. So this essentially follows that there are two types of risk. One are negative risks, which may result in losses. Other are positive risks, which are opportunities for you, which may help you gain more money, earn more profit for the business. That's the idea. So this, as I told you, the traditional risk management is reactive. It identified certain risks, what can go wrong, and then we take some action. So responding to identified risk which occurred, and then we take some action. But in COSO ERM, we are proactive. We take a more forward-thinking approach, more futuristic approach. What can happen and what can happen after that, right? So it's more proactive, more planned. And then finally, traditional risk management focuses on avoiding negative outcomes. This is good, avoiding negative outcomes which can affect the organization adversely, and maintaining compliance, following the laws, regulations, and relevant standards. But ERM, it says just don't look at the negative side. There is also, there is always some silver lining. In the bad situation, there is always an opportunity. Like many businesses which were in trouble during COVID-19, they made some changes in their business structure. They became more IT oriented, and that changed their way they run business. So there's always an upside potential. When you are in trouble, there's the problem. There is always a silver lining. There's an opportunity to make gains. So consider both sides. Consider both upside and downside risk and upside potential. So make a more informed decision by keeping a holistic view of things, right? So it says, consider both upside and downside risk and their impact on the strategic objectives. So you can see COSO is much more elaborate, much more integrated, and takes on a holistic view of the organization. Okay, let us see how they define COSO. We are going to discuss each and every word you see here in our coming lectures, because this unit alone, what you're doing right now, I would say it's about 8% of your Part 2 syllabus. If you give 2% to the traditional risk management, we discussed earlier, COSO ERM is 8%. Collectively, the risk management section D covers 10% of your syllabus. So we are going to dive deeper into risk management, so know every word what it means, to apply every concept as far as practical. So the ERM defined by COSO framework, it says the culture. Every organization has a culture. We will define it. We'll learn about culture in the coming classes. So ERM definition includes the culture, capabilities, and practices. These three things, integrating with strategy setting and performance that the organization rely on to manage risk in creating, preserving, and realizing value. This definition will be broken down to its components and we'll discuss it in sufficient detail. What the idea is that in ERM, we see what is the culture within the organization, what are the resources it has, how the business is conducted, taking all them together to create value, benefit for the stakeholders, shareholders, customers, suppliers, employees, related parties, environment. So we not only create benefit, we preserve it for the future as well. So ERM takes a more holistic approach, not just risk management. It's about realizing value, about creating value, and then delivering it to the different stakeholders. So it's all about the benefit of the various stakeholders connected within the organization and even those who are not connected within the organization. It's all about creating value, creating benefit, preserving benefit, and transferring those benefits created through ERM. What are the benefits of adopting ERM? We are going to discuss all these. I'm just going to have a complete overview of what it is, what's called a bird eye view of ERM. Once we have a complete overview of ERM, then we can go into finer details and discuss each one of them separately. Even the word value has been explained in detail in the coming slides. So I'm just going to give you an overview. So what are the benefits of ERM? Just like a conventional risk management, when we have risk management in place, there are fewer surprises. You are able to utilize your resources more efficiently, and this way, if you have a strong system of risk management, the fund providers, bankers, shareholders, bondholders, they will be willing to invest in your company, and this may reduce your cost of borrowing, cost of capital. So that was what we did in the previous class involving the conventional or traditional risk management. But what are the benefits of ERM? The benefits of ERM are much more wider and diverse compared to the traditional risk management which we have done so far. So it increases opportunities for you, helps you effectively manage risk, helps you generate positive outcomes. It reduces performance volatility, variation in our performance. It improves your resource deployment, enhances resilience. Business becomes stronger so that it can sustain shocks. It can sustain market variations. So overall, it helps in better decision making and it will enhance performance. This is the benefit of ERM. Then we will discuss there are three lines of defense against risk. The first line of defense are the principal risk owners. These are the departmental heads responsible for certain tasks of their daily routine: inventory management, procurement, sales, marketing, commercial, logistics, so on and so forth. These are the principal risk owners, the departmental heads responsible for risk within their department. The second, so they are the one primarily responsible to manage risk. Second, we have support departments. Second line of defense involves two specific departments. One is the risk management, other is compliance. Compliance department, specifically in brokerage and in banking industry, this department is responsible to ensure that the transactions, activities are in accordance with the law, regulations and standards. This is the job of compliance department. This is the second defense. And the risk management department. So these are the two business enabling functions. They represent the second defense. Let's just visualize this. This is a volley of risks coming towards you. So you have some defenses. This is the first line of defense we discussed. Principal owners of risk, the departmental heads, they are the first primarily responsible. If they fail, second we have the business enabling function like risk management and compliance. And the third one is internal audit, assurance function. Internal audit and some part of external audit, they are responsible also for assuring that the business internal control system is working efficiently. So these are the three defenses, first line of defense, second and third. So we may say that internal auditors are not primarily responsible for risk management. Their job is only to see whether the proper risk management practices are being followed, how strong the system of internal control is. Internal auditors are not responsible in any way for the design, drafting, implementation of any system of risk management. They just report. So these are the three defenses which we will discuss in detail in the coming lectures. Then there are different departments, different organizational levels. So they have some role to play. We will discuss in detail what their role is, but briefly, the board is responsible to oversee through different committees. Board of directors form different committees, risk committee, compensation committee, internal audit department, called audit committee, nomination committee, executive. There are many committees. So board of directors have an oversight role. So they have an oversight role related to enterprise risk management. Management, immediately below the board, we have management, headed by Chief Executive Officer, CEO. So management, they are responsible for day-to-day responsibility for managing risk and achievement of organizational objective. Makes sense? And then, below the top management, we have officers. What they do? They facilitate and act as centralized coordinating point to risk management across the organization. They are the one who are actually acting below management, the actual actors within the ERM framework. And then the internal audit department, as I said, they come at the end as a third layer within the first three lines of defenses, and within the one responsible for internal audit and ERM, they are at the end. Their job is to provide assurance whether the risk management practices are in place and how robust the system of risk management is. Your COSO ERM is represented by something, a kind of strip, a central strip, with showing mission, vision, strategy, business objective. If all these are present, it will result in enhanced value, means benefit will be created, preserved, and transferred to the stakeholders. You see different types of strips winding around these the core that you see. First, you see at the bottom is this orange colored governance and culture and information and communication reporting. These two are called supporting aspect components. Supporting aspect component. There are 5 components, and I've highlighted these two first: governance and culture, information, communication, and reporting. So these two are supporting aspect components. They support the overall system of risk management. They provide foundation, just like if you remember in COSO internal control framework, the control environment was the foundation on which the whole system of internal control was constructed. Similarly, this governance and culture, information, communication, reporting, this is the baseline, the bottom, the foundation on which the whole COSO ERM framework will be erected. So, and the other 3 which you see here are strategy, objective setting, strategy and objective setting, performance, review and revision. They are called common process components. They are the one who are actually taking some action within the COSO ERM. We are going to discuss them in sufficient detail, so we don't have to be worried. Let us have a quick overview of these 5 components, what basically it involves. These 5 components have been split into, these are the supporting aspects, as you can see, the first and the last one, orange and red in color. And then these 3 are the common processes: strategy and objective setting, performance and review and revision. So we are going to discuss them in detail. Let's have a bird's eye view of what these basically mean. The first one, just a brief idea. Governance and culture. Governance and culture involves board risk oversight. The board of directors are the one who set the tone and establish the responsibilities of ERM. They are the one who will establish a certain culture. They were the one who will set certain desired behavior, values, how the business to be run, what is the strategic direction. They are the one who will establish operating structure, define the desired culture. We are going to discuss all these as we go along. They are the one who determine the core values. Core values is sufficiently explained in the later slide. These are called essential beliefs. Values, I'm not talking about the value creation, I'm talking about the values. Values are the beliefs in any organization. And core values are the essential beliefs. Every organization has certain beliefs. Some are just beliefs, some are essential beliefs. We'll discuss. So demonstrate commitment to the core values, the essential belief within the organization. This governance and culture will attract, develop, retain capable individuals. A good governance system, a good culture will attract good employees, and they will be the one who will contribute to the effectiveness of ERM. Then the last, fifth element, information communication and reporting. We use information technology effectively so that we can make best use of ERM practices. Communicate risk and information mean there must be various points within the organization that track risks, identify risk. What are the vulnerabilities facing the organization? What can go wrong? And a robust communication system will identify and communicate the risks instantly so that certain actions can be taken. Then, reports on risk, culture and performances. How well we have done. It will prioritize risk, identify risk. We will study in detail. There are 5 risk responses. I think somewhat we discussed also in your traditional risk management system. Risk avoidance, risk exploitation, risk transfer. They are all coming again. So it involves identifying risk, selecting a suitable risk response, and assessing how well have we done. So these two are the foundations of ERM. Then within these 3 components, let us discuss them briefly as well. Strategy and objective setting. Your ERM must support the organization's mission, vision, and your core values, what you call the essential beliefs. Define risk appetite means define what risk you're willing to take. We're going to discuss, I'm just giving you an overview. There's a lot of stuff to cover in ERM. This is the overview, a bird's eye view of your ERM. So define risk appetite, how much risk you're willing to accept. Evaluate alternative strategies. We can have multiple ways to achieve certain goals. So evaluate alternative strategies and assess their effects on risk profile. We'll also discuss what is risk profile in detail. And then based upon this, you formulate your business objectives, and these objectives must be in accordance with the organizational goals. Then next element is performance. Performance means identifying, assessing and prioritizing what the risk business is facing. This part specifically focus on portfolio view. What you have done so far in traditional risk management, you focus only on compartmentalization and siloed based approach where you are managing risk at departmental levels. Here we are going to have a portfolio view where we will integrate these different departments and see how the risk is management across the business. Prioritize risk, which risks are more relevant. Implement risk responses, those 5 risk responses which you identified. Which of these needs to be adopted? Avoidance, acceptance, sharing, mitigation. And then develop a portfolio. This is we are going to discuss in detail in the coming lectures. Then we have review and revision. Once the ERM is in place, it doesn't mean it is going to last forever. We may have to revise, we may have to make changes as things unfold. So review and revision involves review and revision of your ERM capabilities. So you may have to change your strategy. Even you may have to change, in some cases, you may have to change your business objectives. Apparently, a business objective once set is unchangeable. Normally, what are business objectives? The long-term goals: profit, value addition, survival, providing a public service, revenue growth, market share growth, whatever the business objective is. But it is not a fixed thing that can change. If things change, if the risk changes in the environment in which you're operating, you may have to revise your strategy. You may have to revise your objective sometime, right? So in this, we will see how the revision is made in strategy to achieve the business objective, and sometimes the business objectives may have to be changed. So there are 3 principles. There are basically, you see, there are 5 components to it, and they are divided into a total of 20 principles. We are going to discuss these in the coming lectures in sufficient detail. Then review risk and performance. Whatever the risk response you adopted, how did it perform? Maybe some risk which we avoided should have been exploited, or the risk which we shared may have to be avoided. So we need to see how well we have done. So here we may identify and assess changes that may substantially affect our strategy and business objective. So here then finally pursues improvement in enterprise risk management. So in ERM we will assess how well we have done. Different risk responses we applied, how well it worked for the business to create value, to preserve value, and to realize the value, and how effective our ERM overall was. So we are going to discuss all these in detail, and in the end we will discuss the limitations of ERM. ERM is not a perfect model, but it has some limitations as well. Despite its extensiveness, despite its integrated approach, there are certain limitations. First limitation is that all ERM is set up by human beings. So if we make some faulty judgment, the system will have some defects as well. Faulty human judgment. If our judgment is flawed, so the ERM will have those flaws in it. Every response we select, like in this, we have some risk responses: exploit, avoid, transfer, accept, and the fourth one also. Let's see. So each risk response will have certain costs versus will have some benefits. So this cost benefit consideration may ask you to skip this exploitation option. Maybe this was the most profitable one. So this cost benefit consideration sometimes makes you reject certain responses which were basically beneficial for the business. So this is the limitation, that we have to see cost at every side. Maybe the probable future benefits can be much more. So this is the limitation. Our judgments can be faulty. Or maybe we may make simple errors and mistakes that can affect the whole ERM implementation and maintenance issue. Finally, we may have deployed segregation of duties in order to minimize the risk of fraud. We have segregated these responsibilities this way. We have given custody of cash to X. We have given authorization to make cash transactions to Y. We have given the record keeping function to Z, and we have given the responsibility to reconcile records and cash to M. This is for managing the risk of defalcation or risk of cash frauds. Despite this robust segregation of duties, these X, Y, Z, and M, what if they collude? They act like friends and commit a fraud synergistically. X will take out certain cash, Z will not record it, M will not reconcile it, and X will authorize the issue of such cash. So when they do this fraud together, this is called synergistic fraud. This is also called collusion. That segregation of duties is in place. Despite that, workers may collude to commit fraud. And finally, sometimes the management, who is at the top of the food chain, they override ERM practices. They are the one who violate the rules. So these are limitations of ERM. So this is the overview of ERM, just an overview. There's lots of stuff coming that will fill in the knowledge gaps that may have left right here after this lecture.